Hey everyone, and welcome back to the channel. Today, we're diving into a topic that can make or break your financial future: the critical difference between a temporary market decline and a permanent loss. Because in the world of investing, these two things are worlds apart, and confusing them, particularly during moments of investor panic, can cost you dearly. You've probably heard the market described as a roller coaster. It goes up, it comes down, sometimes it drops sharply. These downturns are what we call temporary declines or market volatility. Think of them like a big sale event on the shares of good businesses. Historically, the S&P 500 has experienced declines of about 30% roughly every 5 years on average. Even during massive crises like the global financial crisis of 2008-2009 or the COVID-19 pandemic, these were ultimately temporary drops. Despite widespread fear, superior companies consistently resumed being superior companies, growing their earnings and dividends over time. But then there's the permanent loss, and here's the crucial point. A permanent loss is almost always a self-inflicted wealth destruction. It happens when investors panic during those temporary declines, sell their assets at depressed prices, and then, critically, fail to re-enter the market. You effectively lock in your paper losses permanently. You run out of the store when prices are low, thereby missing out on the inevitable recovery. So, why do we do this? Why do we turn temporary volatility into permanent financial destruction? It comes down to three powerful, natural human impulses that consistently work against our long-term investment success. Number one, losses feel twice as bad as gains feel good. A significant portfolio gain, like 30%, might feel just okay, as if it were expected. But a 30% portfolio decline, even though the S&P 500 experiences them regularly, can feel like an existential crisis. This disproportionate emotional weight for the same percentage change is an unconscious choice, leading us to want to stop the bleeding. Number two, lower prices. Feel bad. This is a big one among the pitfalls. In almost every other aspect of life, a lower price signals increasing value, a sale. But in investing, when stock prices fall, our instinct tells us it's a sign of increasing danger. We often feel good paying more for stocks, when we should feel better about shopping a sale. As
Prices are
Cullen
too
Rush is
low!
quoted, the stock market is the only market where things go on sale and all the customers run out
Run
of
for
the
your
store.
lives!
This
Prices are
running
too
out of the
low!
store is instinctive, not rational, and frequently leads to long-term regret.
Run!
Number three, this time it's different. As markets fall and fear rises, it's incredibly human to lose the ability to distinguish between a temporary decline and a permanent loss. This leads to the dangerous thought, this time it's different. But as renowned investor Sir John Templeton famously warned, those are the four most dangerous words in investing. While every crisis is unique in its specifics, they have historically never yet been different where it really counts in terms of long-term recovery. These impulses, if acted upon, are what cause investors to bail out of their long-term plans and wait in cash for things to settle down. They cause them to miss out on the incredible power of market recovery. Equity investing is primarily an issue of temperament. It's not about being the smartest or the best at timing the market. It's about how we react to what the market is doing, or more importantly, choose not to react. So, how can we develop that crucial temperament and resist these very human impulses? We suggest a powerful reframing exercise. Stop calling them stocks and start calling them companies. Stop calling ourselves investors and start calling ourselves owners. This reframing from investors in stocks to owners of companies is intended to have a different, more positive emotional effect. Thinking of your investments as substantial companies like Walmart, JP Morgan Chase, or Marriott can lead you to accept that historically, lower prices have always signaled better value. History is our greatest teacher here, demonstrating the resilience of markets despite severe temporary declines. Think about it. The 1973-74 crisis with the oil embargo, inflation, and Watergate The 2000 to 2002 dot-com bust, 9/11, and corporate accounting frauds like Enron. The global financial crisis of 2008-2009, where the world's credit system nearly ceased to function. And most recently, the COVID-19 pandemic, where the world's economy was locked down. Each of these events felt catastrophic and unprecedented in specific ways at the time. Yet, despite widespread fear, the market eventually recovered and reached new heights every single time. Great companies grow their earnings despite crises, and their shares have overcome even the deepest declines more rapidly than expected. Dividend growth, in particular, has consistently outpaced inflation. The lesson is clear. Human nature often has it backward. When stock prices fall, the enduring value of the underlying companies is actually rising. Therefore, selling high-quality core equity investments during such times is the last thing in the world you would ever want to do. It's about resisting that very human impulse to run out of the store during market downturns.
Run for your life!
So, next time the market gets choppy, remember this. Volatility is normal. Temporary declines are an inevitable part of investing, but permanent losses are a choice you make out of panic. Focus on your temperament, reframe your thinking, and let history be your guide. You have to stay in it to win it.